Well, let's take a look at the soybean market. Always a fun market to watch. It is leader right now in the grain market, leading significantly over the corn and wheat market. Well, we have put in as you can look back here, we put in the seasonal high last year, right when you would expect it to go in, and that was in June. Sold off consistently so during the harvest pressure, and we have bottomed out just about where we would expect it. So the seasonal bottom is in because we've seen a couple of higher highs, and it just at this time of the year haven't even entered December, and we're already seeing some pretty bullish price action. So that bodes well for the first and second quarter. If we look at the weekly here, let's minimize and look at the long-term thing. You can see we had about 10 years here we were steadily moving higher, and these highs usually were these good runs were preceded with higher fall lows from the previous year. In the last 3 years we've been on the defensive, just steadily making lower lows until well, just right now this fall low is significant because it's higher than the last one. So when we look at the potential going forward here on the weekly, if we can get above even just this supply zone up here is a buck higher. We just want to buy it back on a dip in a shorter term demand zone. But this will offer some pretty good risk reward ratios if you do have the patience to wait for a dip. Right now if you chase it, not so. But if we take this out and we head up and we challenge this one from 2 years ago, now that's a good run. That's $3.50 higher. So let's take a look at the daily, and you can see that well, the fall, don't forget your technical analysis, because the actual bottom here, when it popped out, it formed a nice little coil, nice little symmetrical triangle, and these coils happen all the time. We even had another one before this breakout, and this would be a declining wedge. So sometimes these coincide with your zone. So I'm always looking for confluence of technical analysis, candles, and zones. We've rallied up here. Now we're looking at this large overhead supply. So we're looking, we want to buy it back into a dip. We need to, you just can't chase it, certainly not after 7-8 days to the upside. So let's look at the 60 minute. Now the 60 minute is going to break down your demand zones a little more carefully here. You'll be able to see that there's just one even 10 cents lower, which gives you an initial opportunity. This would be even better if we geek down into the 1035 area. Now, how do you know when to bite? Well, what I usually look for is just, see, I look for a candle signal. So when this last little wave of momentum to the upside occurred, it left this demand zone right in here. It was retested, but what made it significant was the fact that it put in this piercing pattern, which was further enhanced by the fact that the bars were so large. That's a perfect opportunity. Now, if you have the software and it's showing you the demand zones and you know your candles, you're in business. We're only talking about knowing about a dozen or so major reversal candlestick patterns. All right, so that's what I'd be looking for, and if you can get that, then you're certainly going to improve that risk-reward ratio. It just doesn't pay to chase it. This also has a good liquid options, and it has a mini contract that can be traded not on for day trading, not enough liquidity there, but it certainly works very well for swing and position trading. So that's the beans, and you always want to go with the leader. Beans are leading the grains to the upside. Thank you very much.